welcome to the live stream. Let's see what the market's doing today and see if there's any opportunities to get into some stocks. To evaluate stocks and look at their fundamentals. Sometimes stocks are popular, but I want to make sure they're valuable. But I want to make sure they're valuable. If you look at the best companies on the stock market, the most valuable ones, they all produce high free cash flow. High free cash flow. That's why I'm looking for high free cash flow. All the best investors depended on free cash flow and evaluating a company's ability to generate free cash flow. A company is not the stock price, and the stock price is not the company. They're two different things. Two different things. The big cap stocks have taken the show, but are big cap stocks gonna come back? Gonna come back? Chinese stocks are exploding. The dragon has awakened in China. And could be the best trade we've seen in a while. AI hype is really interesting. AI is going to be interesting in the future, but is it really a business today? I'm going to pass on this stock. Just not enough discount, and I'm not really believing that they're going to grow as well as they should. Options can make your performance go a little higher every month and generate nice income. Listen to the great super investors. They are pretty generous with their knowledge and their wisdom. You just got to read their books and listen to their videos. Learn something new every month. In investing, you'll become a great investor. You'll build wealth. This is a buy stock. You're looking at a discounted stock, and it's unappreciated at this time. Don't forget about bonds. Bonds are a smooth, consistent way of earning a good return. And when stocks are really crashing, bonds stand up tall. Bonds stand up tall. You got to ring the cash register and take a gain. Defining when to sell a stock is a lot harder than determining when to buy a stock. And over time, you'll become a great investor and you will build great wealth. Hey, super investors, how are you? It is good to be streaming while the market is in action. We've got about a little less than an hour to go in the market. And I thought I'd stream while we've got the market open. Maybe there's a stock you want to kind of evaluate, see if it's a stock you want to pull the trigger on, whether you're buying it or selling it. It'd be fun to do that. Mike, I've got your stocks. It's a pretty good list there. I think I've got valuations on all four, so we can fly through those. Now I'm showing up with a lot of requests. Members of the channel have requested, including Mike's. I've got a list of 10 stocks we're going to look at. A lot of these are small caps, and that's cool. Small caps could really perform great. So I've got a nice list to go. And if you guys are new to my stream, since I'm streaming here at a different hour, I'm a long-term investor. I like looking at stocks from a long-term perspective, valuing those companies based on the free cash flows that they're going to produce. If they're going to produce a lot of cash flows, I discount those cash flows to today's value using a model I've created, and then compare. What is that value compared to the share price? Is the market pricing the stock too high, or is the market pricing the stock correctly? At the end of the day, I want to buy a stock and make a lot of money on it. And oftentimes the market will misunderstand a company and really discount it and it's a great opportunity to buy at the right time and make a lot of money long term. I also look at earnings per share. For the most part, those are the two methods that I look at. Earnings per share, not as important to me. I want to know what the market is seeing, how we value the stock according to those valuations. There are some stocks that don't fit those models, like banks. I use a different method. I don't use free cash flows. Real estate companies, same thing. Can't use free cash flows because it just wouldn't give us the right valuation on those businesses. So that's the method I'm going to use on this stream. And I'm going to get through as many stocks as we can. You know, you bring up the stocks. If you're a member, you know the drill. Just use the chat. Let's take a look at stocks you're interested in. If you're not a member, no big deal. Just buy a $5 super chat and I will cover your stock, or become a member on the fly. And then you can request the stocks that you would like. Right now, the market is, the S&P is trading higher, and it had moments when it was in the red, and then it's really gone higher, which is nice to see. I'm glad that I put my buy orders early in the day. I'm not a day trader, but I'll take it. You know, if you get a little gain intraday, there's nothing wrong with that. There's nothing wrong with that at all. For the year, S&P is up 16.5%, so it's getting it done. The market is definitely getting it done for investors, increasing the wealth of every investor who's taking it on themselves to invest in the stock market, to become more intelligent about stocks, taking the money they've earned and having that money work 24/7, 7 days a week. That way you have economic freedom. Whether you want to retire early, you want to buy a nice house, you want to travel the world, if you have the economics, man, you can do it. Well, let's do that. Let's build it with stocks. That's what we're going to do here. All right. So the market's rolling. I'll take a quick peek at the heat map just to see what kind of action we're seeing in sectors. NVIDIA is giving up a little bit of its massive market cap, but hey, it's still a super winner. Apple's been, you know, in the green for the most part for the last couple months. So good job, Apple. They have been growing their business. You know, they've been selling more units of their phones, which is positive. So that's looking good. And other than that, you know, the application space is picking up a little bit. Looks like Salesforce is in the positive. Adobe, now that's a sight for sore eyes, man. Adobe's been getting hammered this year. Can it catch a break? It's catching a break today. We'll see if it establishes an upward trend, because that stock, I think, is discounted. Looks like IBM is catching a bid. We got some red in hardware, as well as the semiconductor materials companies. And we got a lot of green over here in these sectors that are not quite as valuable as these tech sectors, because they've been left behind for the last 3 years. Healthcare, doing nice. Look at that nice green, emerald green. Emerald green, there's a lot of money being made here. I am glad I've got some positions there. And I think this particular area of the market is going to flourish. And Peyton, I see your comment on Applovin. I'm going to put Applovin on the list. I bought more Applovin today. You want to give me a discount on that stock? I will take it. I will take it and run with it. We'll take a look at Applovin. I didn't see any news that was bothering me. It's just the market was selling off the stock. So I'm good with the discount. Thank you very much, stock market. Energy sector's up. That's good for people that own energy stocks like myself. Materials are up. Real estate is up. And I think real estate's got a pretty good position going forward as we expect these lower interest rates. Consumer staples are up. So there's some pretty good green in some of these sectors that have been left behind in this market. Now we've got an array of earnings that have been coming out, and smaller earnings, but we did have Sony, the legendary Japanese electronics company, as well as they have a movie studio, and they have a variety of things. I'm not all that interested in Sony. They don't grow a whole lot. That's somebody else's investment. But I am an investor in C Limited. And C Limited, I thought, had good earnings. And the stock's trading down. Who would have thunk? Gold has been flourishing this year. Anglo Gold announced. Some others, Nebius announced and they're down. Oklo is going to announce after the market closes. We'll take a peek at that after the market closes and then they announce. I'm curious to see if the market's really buying some of these stocks that don't have revenues, but have an idea. They have an idea and these investors are like, hey, I want to buy into that idea. Hey, good luck with that. That's not my investment. I like seeing great ideas with great cash flows, great profits, or evidence that I'm going to get great free cash flows in the future, great profits in the future. I need to see the evidence, and I don't see the evidence with Oklo, and we'll see how that stock trades. All right, so that's a quick flyby. Let me look at the chat. Looks like we've got some new names for me. Thanks for joining. I appreciate you joining. And Peyton, I noted that Applovin is on the list, and Mike's got a comment here. So an insider sell, 125,000 shares, small downgrade. Yeah, I agree that that's not enough to drop the price. Now, I know we all invest the way we want to, and we all interpret behavior within a company the way we want to interpret it. Keep in mind, if you are either one of the founders of a company like Applovin, or you're one of the early employees, and let's say you're fortunate to be sitting on $100 million of stock, and your spouse is like, hey, we got this small house and our family's gotten larger. We'd like to buy a bigger house. Can you sell some of your stock? Absolutely. That's a good reason to sell your stock. Or you want to diversify, right? One of the rules of holding on to your wealth is diversify. If you put all your eggs in one basket, all your capital into one stock, and that stock were to really suffer, your wealth suffers. So diversification is a good idea. So I don't necessarily find it overly bothersome when an insider sells shares. Sometimes there's life events, there's a diversification that investor wants to do or have. I principally want to look at the business, and Applovin's been growing the revenues masterfully, just doing a great job. They've been accelerating their growth. So all the things I'm seeing from the business side, profitability, cash flow, Applovin's in great shape. So I'll buy more Applovin, and we'll cover that in a little bit. To lead off today's stream on the analysis side, I want to look at SLB. And I think this company was previously called Schlumberger. And you have to pronounce it that way. That's what insiders, I guess, how they would pronounce it. But it's written, in essence, it's not written like that in English. So they changed the name to I guess, avoid confusion, to SLB. And they do services in the energy sector for oil companies, principally, that need oil rigs created, serviced, all kinds of services for the oil industry. And they are part of the energy complex, but they don't necessarily own, rights to extract oil and put oil in the market. They're just, making money off of the oil companies. So that's what they do. They have a 3% dividend. Now, the oil business hasn't been great for the last year. It was great for a couple years. Coming out of 2021, oil prices really went up nicely. And oil companies, their stock prices were flourishing. But ever since then, oil prices have kind of been pretty much tamed. Right now, we're sitting on like $60 per barrel oil price. It's been going up on a few days, which causes a nice rally in energy stocks like we're seeing today, but nothing extensive. Like if we had oil prices at $100 per barrel, we'd be seeing energy stocks just double in value quickly. And we would see Schlumberger or SLB, they'd be busier than heck because oil companies would be like, hey, get out here. I need you to either drill a new well. I need you to service a well that's inefficient. I need to extract more oil while the barrel price is really high. We want to grab all that cash. We want to grab all that profit while the grabbing is good. But for the last couple of years, that hasn't been the case. Now, what are oil prices going to do in the future? Well, I don't have even a guess. I could just tell you oil tends to move as supply and demand changes, or if there's a big event, like if we have a war that is going to disrupt the oil flow out of the Middle East. More recently, the United States put some sanctions on Russia. Russia does have a lot of oil. And I think that did create a reduction in supply. So that's been going on. But enough of that. Let's take a look at how SLB has been growing. In the full year last year, they grew some, but the last 3 quarters, I'm seeing some red here. That's a problem, right? We're seeing that, that per barrel price is not high enough to create more volume. So we're seeing a decrease in revenues. Now, we can explain it because just the economy for energy is what it is right now. So no big deal. It's not like this business is being operated poorly, but it is a factor in my decision on a stock. Is it a good time to buy more energy? Maybe, but I'd rather own the company that's going to make the most amount of money, which would be the actual company that extracts the oil and sells it to the market. This company is going to make money while there's booms. Moving on, analysts, 15 of them cover SLB, and they think it's a nice discount available, 31.5% on SLB. Looking at their forecast, and I'm not sure where they're getting this forecast, but it's going to be a slow grower, single digit. That's not bad growth, but it's not exciting, right? It's okay. And the margins are okay with this company as well. Profitability is going to expand, but the PE ratio is going to go from 12.8 down to 10. Could it rally a little bit? I think it can, because when I look at the value of SLB, I'm calculating an 18% discount on the stock. When I compare the value of their cash flows versus their stock price, then the value of their earnings per share versus their stock price. 18% doesn't get me super excited because I can get a better discount on Occidental Petroleum. I can get a better discount on Chevron. I could list out 20 companies where I think I've got a better upside situation where I could see a stock price really go up nicely and I'm getting a better discount. So for me, SLB wouldn't be the right investment, but for somebody else, maybe a dividend oriented investor that wants that 3% dividend, this isn't a bad idea. I think SLB will continue to, be okay. It'll grow slowly. It'll pay that dividend because it knows investors are in on the stock to receive that dividend. So for that kind of investor, have at it. I think it's a good idea. But for me, I'd probably want to buy something else like a Chevron, which pays a better dividend, or an Occidental, which has great upside. If we see the per barrel price go up, you can see Occidental double in value very quickly if we see a big spike in oil. So that is SLB, covering a request that we had from a member of the channel. Let's move on and we're going to cover a quick one that came up on the stream because I've got, it looks like 5 more that were sent to me in advance. So let's go over Instacart. That was on the list that Mike put out there. I like seeing Maple Bear have a good day. This is Instacart because this stock here doesn't get a lot of support from the market. It is in competition with Amazon to some extent because Amazon's trying to deliver groceries. Now, I think Amazon's terrific. That's why I own the stock. But Amazon can't do everything to all people. They have not been successful, for example, in healthcare. 10 years ago, they said, man, we're gonna completely reinvent healthcare. And they were not successful in doing that. They're still in it, but there's not really they're not a big factor in that market. And I can point out to some other examples. And I think with grocery delivery, the specialization is going to be important because we're dealing with food, right? I want the food that I'm ordering on Instacart to be delivered properly. We're actually going to use Instacart because they have a partnership with Costco. My job, showing up to Thanksgiving with my sister, she's wonderful. She's going to cook the meal, is to bring the pies. So I'm getting the pumpkin pie from Costco and an apple pie because I like the apple pie. And we're going to order them on Instacart. It's branded with Costco, but it's Instacart in the background. And they're going to deliver them. That way we don't have to go to Costco. Because if I go into a Costco, it's impossible for me not to spend a couple $100, right? Because I'm going to see all these deals and then put them in my basket. So instead, hey, limit the damage. Order those pies. We get the pies delivered. And we're good to go for Thanksgiving. So that's an example of me using Instacart. And I think, the general public, the consumers are using Instacart far more. The market cap's tiny compared to Amazon and others. And these guys have a PE that's very reasonable, 23 and 18.7. The analysts believe it's discounted. Now, the story that's causing that discount is, Amazon's going to put them out of business. And I just don't believe that story. I think it's more fiction than it is fact. And to support my argument would be Instacart's growing by 11%. And you see that they're accelerating their growth nicely into Q2. So 11% growth looks pretty healthy. They have the ability to grow partnerships like the Costco partnership. They're partners with Kroger, which is a huge grocery retailer. All those factors to me are telling me Instacart is going to continue to grow. They're going to continue to grow. They're going to continue to flourish. And let's take a look at some other factors that I like to look at. Now, I like buying businesses that make a lot of money. And Instacart qualifies because they're making 75% gross margins. 75, beautiful. And if you look at the grocery business, it's a very low margin business, but these guys aren't buying the inventory and selling the inventory. No, they're just delivering that inventory and using drivers. So that's a very, very good gross margin number. I like the margin number, and they get nice profit out of it. A very good free cash flow yield of 22%. So the things I saw in the earnings that they announced on November 10th, I thought were pretty productive, positive, good. And the stock sold off. The market's like, man, Instacart is guilty until proven innocent. And then investors, I bought on these dips. I'm like, the market's crazy. And now the market's like coming to its senses and saying, no, this is a good stock. It's up 7% today. Great to see that. It's a buy stock for me. It's a good stock to own. I own Amazon. It's okay to own a couple, especially since Instacart is a smaller cap, right? Well, I've got a lot of conviction that Amazon's going to be an awesome business going forward. They have a good diversified business. So I'm comfortable with my Amazon investment, but I'm also very comfortable with Mapleberry because I think this stock could really double, triple, quadruple in price. And it could be an acquisition target, $10 billion. Are you kidding me? A big business could buy them quickly. Bam. Maybe Uber buys Instacart. Maybe one of these other, communication services companies buys Instacart. We will see what happens, but I think this company, if left alone, is really valuable. Their free cash flows are terrific. And I'm discounting the free cash flows by a higher discount rate since they are a smaller cap. And so the discount on cash flows look terrific, 65%. And the discount on their earnings per share, using a P of 25, because I think they deserve it with the high margins and good growth, 39%. So sign me up for more shares of Instacart. You want to discount them? Thank you very much. I'll take more shares. And I'm glad I bought that dip because now those shares are worth more. And very quickly, I made money on that investment. So Instacart is doing well. I think, Mike, you're in Instacart. I hope you're doing great with the stock. And thanks for asking about that. Let me check the chat. Falls Grave, how are you? Hopefully you are doing well. Yeah, sorry about that. The streaming software that I've got gave me an option. I guess it's a feature they just added. This is my first stream with it, where I guess for mobile devices, they're trying to put it in a portrait look. And thank you for the feedback. I'm going to think about the next stream and changing it. And it's supposed to either, based on the device you're using, is then adjust. So if you're on a phone, I think it's going to give you the profile or portrait view. If you're on a computer, it's going to give you a full view. But thanks for the feedback. If others feel the same way, please put it in the chat. I'd really appreciate you telling me, even though you might feel like it's a negative comment. If it's a bad look, please tell me, because I don't want to do it again. It's an easy adjustment. I could just change it. Thank you. All right. You want to look at ALVO. And I will put it on the list, sir. All right. So jumping down the list, I'm going to go to the list that was provided to me prior to the stream, and a stock that was provided, small cap, BWAY. Never seen this stock. So we are venturing off into the unknown. We've got BWAY develops and sells non-invasive neurostimulation treatments for mental health disorders in the United States, East Asia, internationally. It offers deep transcranial magnetic stimulation platform technology for treatment of major depressive disorders, anxious depression, obsessive compulsive disorders, smoking addiction, bipolar disorders. Okay, so they're helping people with mental health. Interesting. And let's take a look at their website. So these guys use this device. And I'm reading as fast as I can here. I'm not going to read it out loud so I can get through it quickly. So it's this device. I guess you put it over your head and it creates some type of stimulation, maybe to help your mind go to the right place. And I'm not a doctor. You're going to figure that out very quickly. Here's a nice demo. Here's what we're dealing with. So this is the treatment. You saw the image there of that young lady getting the treatment. So I hope this really works, and I hope it helps a lot of people. It's TMS. Okay, very good. So I have heard of that. Okay, so I understand what they do. Now let's see their numbers. So I understand high level what they're doing. Now let's understand the numbers and see what's going on with this stock. So they're a very small cap at about $300 million in market cap. Stock's doing well this year, up 39% over the 5-year, doing really well. Okay, that's pretty promising. Year to date, 60%. This is going to be a healthcare stock. They have a high PE, but if they're growing fast, it's going to be completely rational. So I will, let me try to adjust. So DJ, thanks for letting me know. Let me see if I could adjust the portrait versus the landscape. And I don't know if I'm going to be able to do that, but I don't know if I'm going to be able to do that on the fly. Let's see. All right. So it looks like I'm not going to be able to change it on the fly. You know, thanks for letting me know. I'm going to try to fix it. I'm going to try to fix it for the next go around and try to avoid this. And I apologize for that. Let me see if I can change it one more try here. Nope, can't change it. So, well, the software company suggested this, and it's not good. So I apologize for the inconvenience on this stream. You're not going to see it again. I'm going to take it off on the next stream and try to do streams without it until they improve the functionality. So let's get back to BWAY. So we have a small cap. It looks like their stock's been flourishing. The stock has been growing its revenues. I should say the company's been growing its revenues. When we look at the quarterly, there's good green on the screen. This is a small business. So the growth is good, but not great, right? The take of this product has been positive, and it's good to see that. It's just going to take them a while to be a substantial company. And when we look at their gross margins are terrific, 74.5. They are profitable. That's good. And the free cash flow margin is terrific. So this company, if we look at free cash flow, 18.73 million, based on their growth rate, I would multiply that times 30 and then take away debt. And that's roughly the value of this stock to me. And when I look at their debt to cash position, they have 78 million in cash, $6 million in debt. So they pretty much don't have any debt. They can pay off debt very quickly. So that's not a problem. So 70 million, they were at, they were at 18.7 million. Multiply that times 30. It's going to get me to about 550 million plus the cash. So this business, back of the napkin, it's actually worth 620 million. If I measure the cash flows and they consistently grow at the rates that they're growing. So this is a discounted stock, and it has been recognized by investors. The stock is appreciating in value. I think the need is out there. And it looks like in 2025 is when they are experiencing some tremendous growth, but I didn't see 335% growth. Where is this growth coming from? And then future years are expected to continue to grow. So let's take a look at their actual investor page. We'll take a look at the financials from their investor page. So they announced today, they announced before the market opened. And was the stock trading higher? No, it's trading lower. So based on what investors read, they were disappointed. So they grew revenue by 29%. Full guidance, revenues will be 51 to 52 million. Okay. So we went over cash and liabilities. Last year, for the first 9 months, they were a $29.6 million revenue business. Now they're at 37.6. They're going to end up a little more than $50 million in revenue. So I'm not, I'm not sure where stock analysis is getting their growth rate, but that's all right. We know what it is. So they're growing at 20 to 25%. That's terrific. And analysts think that this thing's going to grow in 2026 and 2027. So this is a good looking stock. It's a small cap. Now the market is selling it off. It probably expected the company to perform better. And you got to do a lot of homework at this. This could be a really good winner because it's a small cap. But I think there's a lot of research to be done. Fundamentally, this looks good. This looks really good. So let's see how it goes. So that was BWAY, and that was Brains Way. And that was a request. All right. All right, moving off that, let's go over to eToro. eToro is making some noise, some positive noise. And let's take a look at it. So eToro, for a while, this is a new IPO stock. If you look at, they've just been trading since May 14th of 2025. And I try to stay away from IPOs because they tend to do this. They tend to sell off, which is not good. And the sell-off tends to happen whether the business is good or bad. And I just let IPO stocks maybe announce for 4 quarters, and then I get serious about them. It's good to see that this stock is up 10%, and they have terrific fundamentals. These guys are growing well. They're very profitable, and they generate cash. And they also are selling into a market that's primarily in Europe, which is a good idea. In the US, you got plenty of competition, and probably the most exciting brokerage like business is Robinhood, that's been flourishing and going up in value. These guys are predominantly in Europe, which is a good idea, focused on that market. P ratio is really low and is staying low for 2026, considering that these guys are growing really nicely. Let's take a look at their growth, and in the earnings, look at this fantastic growth. Who wouldn't like 123% growth rate company? They're growing really nice. They got into crypto. Who as a brokerage isn't in crypto, right? But these guys have gotten into crypto, and their brokerage business is doing well because investors want to buy stocks. They are doing well on the growth rate, very, very well. And they're generating cash and making money at the same time. So that looks good. So eToro looks terrific. I've made a lot of money on Robinhood and Futu, which is over in China, Hong Kong. This one here is on the list to watch, but I think it's whoever owns it, congratulations. You kind of deserve it, because this year this thing's been selling off, and it's been the market hasn't really given it many breaks. This stock has kind of been sold off, and we'll see if these guys establish an upward trend. If they do, I'll be a buyer, because I'd rather show up a little too late on eToro, because there's so much upside potential in this stock. I think it's discounted by 47%, and that's with a discount rate of 11%, showing that this is going to give me a really good yield. So if this thing were to have a good couple of weeks, I would get pretty serious about maybe buying eToro. But I'm going to give it a couple weeks. I'm going to let it kind of, take this good news and see how the market behaves. See if the market's going to buy up eToro. But it's looking good. I'm glad. These guys deserve a break, because if you're growing that much, you're making money and generating cash. I mean, what else does the market want? That's exactly what I'm looking for. All right, let's keep moving. We're going to move over to ALVO, EALVO, Alvotech. Never heard of it. So Alvotech, through its subs, develops, manufactures biosimilar medicines for patients worldwide. It offers biosimilar products in the therapeutic areas of autoimmune, eye and bone disorders, as well as cancer. They're headquartered in Luxembourg. They're a drug company, healthcare. Okay. They are a $1.77 billion market cap company with revenues of $562 million. So that's not too expensive of a company stock. P ratio looks pretty rational at 25. They're growing. 24 for 2026. High discount, according to analysts. Now, healthcare in general hasn't seen a lot of good days. The market hasn't treated healthcare companies all that favorably. And, I'm taking that into account, that at some point it's going to look better. It's going to look a lot better. And I think that companies like Alvotech and others are going to really flourish going forward. But I don't know when that's going to begin, because a lot of these stocks are really sold off. When we look at what these guys are doing, it looks like in 2024, they just really, set a high standard. 426% growth. Wow, that's incredible. Now, they are letting up a little bit on the growth, according to Q2. And it looks like they haven't updated their numbers yet. Now, they announced tomorrow. So I'm sure investors are waiting on that report to see if they can start growing. But although this is 12% decrement, look at these numbers. These are fantastic numbers. So they've been just cranking out their product. Their product is being well received by the market. They really like what the product does for patients. So that looks good. And let's take a look at the free cash flow and profit. They are generating free cash, which looks good. For a young business like this, generate cash, it's a very positive sign. They also are doing okay with gross margins. I've seen some companies do better than that, but that's pretty good, 57.4%. And profit is good. So for a company to be growing fast and generate profit and cash, this makes them very special. And it's really hard to establish what their free cash flow is going to be with just one quarter. Let's take a look at their growth. Their growth is going to continue, and they're going to be over $1 billion in revenue. That looks terrific. And their P ratio is going to go down to 4.8. How is that possible? So let's take a look. So over the 1 year, this thing is down 55.67. It's been growing. It's now making money. So this looks like an opportunity. They're going to announce tomorrow, and I would really study that earnings. And if they're setting up a trend on their top line revenue for growth and the profits there and the free cash flow, I mean, this is looking like a really good opportunity because the market's doing the opposite to where the fundamentals are going. You look at this kind of growth. I could understand the last quarter maybe disappointed the investors with a 12.79% decrease in revenue if you measure it percentage wise. But if they get back on track and show some growth, maybe this stock flourishes. If they come in tomorrow and they have a growth rate of like 40, 50%, this thing's going to scream up, I would imagine. But I mentioned this earlier when we covered that other healthcare company. The market has not been treating healthcare companies kindly. It's been pretty much leaving a lot of them out of the rally that we've experienced for the last 3 years. But if we see businesses like this, we got to keep an eye on them. Once they establish a good upward trend, we have the fundamentals to see a business like this have a long-term appreciation run. So that one looks pretty interesting to me. We're less than 24 hours from them announcing. So I would really study that earnings announcement tomorrow. And so why did they drop so much a week and a half ago? Was there some news? Did they get into some kind of trouble? Yeah, I can't answer that question, Mike. But if anybody's looking at this stock, you should research what happened. You know, what happened over the a week and a half ago. It dropped really, really bad, and there was no earnings announced. Was it a competitor that is going to compete against them? Got approval from the FDA, something like that, which would be, information to take into your decision on a stock like this. But that's a good one. It's a good looking stock. All right. So let's take a look at the market, see what's going on with the S&P and the other indexes. S&P is up a little. The Dow is really doing well. And the NASDAQ's still lagging a little bit. When we look at the heat map, we were kind of like where we were before. Yeah, the Dow is doing great because these consumer staples, energy, healthcare, this space is helping that Dow have a good day. And NVIDIA is keeping the NASDAQ index down. But, NVIDIA's done great. So that's where we're at. All right, so let me clean up my screens here. All right, next stock up, another small company I've never heard of. ENGN. enGene Holdings. through its subs, operates as a clinical stage biotechnology company that develops genetic medicines to help patients suffering from bladder cancer. Its lead product candidate is a detail. I can't pronounce that. All right. So these guys, the 1 year looks okay. It looks like some good news has come out. Low revenue. It's all selling expenses. Sorry. They have no revenue. Now, on a stock like this, if you understand medicine, you understand what they do, and you feel like these guys are going to be successful, then you might be able to invest in a company like this. It's up 50% today. Wow. What was announced? So something related to their FDA approvals has probably come out and made the stock go up so much. Yeah, it looks like the results were better than expected. So it's going to be a treatment that's going to be better than expected. So so this stock here, back to how I invest, I need to have some fundamentals because I don't understand the science, and I'm not going to pretend, or I'm not going to become a doctor overnight to pretend that I'm going to understand it. But if you do know medicine, and you might be able to say, hey, that treatment's going to really work. So if that's you, good luck with it. I'm not in that boat. And it looks like some analysts are really positive on this company. So they think that this company is going to start selling its product in 2027 and then really flourish in 2028. So this one here is a pass for me because it doesn't fit into my process. But again, if you're somebody who understands the medicine, this might be a good investment for you. Good luck. And that was a request. Looks like we're getting some details on ALVO. Let's go back to ALVO and read some of these stories, some of these notes that are being shared. So we've got so the FDA had a comment and the company cut its EBITDA outlook. Okay. Okay. So that's the news. So you want to look at DLO. Let's take a look at DLO. I'll put it on the list. We got a couple stocks ahead of it, but we'll take a look. Good to see you, DJ. Sorry about the screen, guys. I'll fix it for the next stream. We'll get it right. I'll just go back to all landscape. None of this this new feature is not working for you guys, and I apologize for that. All right, so let's move over to DSP. What's going on with DSP? So Viant Technology up 21%. Incredible. They announced yesterday, and this stock has been really struggling, and it's good to see it pick up. It struggled over the 1 year to date. Let's take a look at what they announced. So November 10th, these guys should have announced after the market closed. And the forward PE on this is 18.37, which is 2026. And let's take a look at the earnings. See, the revenue wasn't fantastic. So what is the market in love with? We'll open up their earnings release because I'm curious. So 7% growth isn't fantastic. So free cash flow went down. That's not good. Gross margins are where they're supposed to be. They are profitable and they have free cash flow yield. So let me take a look at the news stories. Okay. So the numbers don't align or don't match a 20% jump. It's the revenue's not great. 7% revenue growth is not great. But maybe they guided with a very optimistic guide. 10 analysts cover this stock. They think it's highly discounted. I'm not going to argue with them because this stock has been really sold off. Revenue growth is expected to be in the mid-teens. So it looks like they're going to get growing a little better than that 7%. And they are going to maintain their profitability, growing their profits nicely in 2026, 2027. And their PE is coming down. It'll come down to, in 2027, to 18.66. Now, if these guys can accelerate their growth, that would be the magic that's needed for a stock like this. And I would want that stock to increase. Now, it's interesting that on a day when Viant went up 20%, Applovin is going down substantially. This is down 8.69. I didn't see any news that was making me feel different than Applovin, and their growth is excellent. So I bought more shares, and I'm glad I bought more shares. And I don't see any reason why not. And these guys are catching a really nice bid, and they really needed it. It's been a beaten down stock, so it's going to have to really rally for a while to make investors happy that bought back in July, as an example. So this one here is a small cap, 654. Their growth isn't amazing. That's my concern is if you don't have amazing growth where you're really small, you should be able to grow quite nicely because the numbers you're growing are not that big. So you should have a nice percentage growth. That's been my concern with Viant. And when I value the stock, I do have a discount, but I'd rather buy the leader of the pack, which is Applovin. I think Applovin is a better play for me, and I'm staying out of DSP for the time being. They have a discount of 33%. That's before I updated the numbers. The numbers didn't look all that great, by the way. Their free cash flow went down, and their revenue growth was concerning. So I'm going to have to investigate those numbers and see where I'm going to land. But to all those that own DSP, congratulations. It's rising really nicely, up 20%. All right, so let's talk a little pizza. Let's talk a little bit about Domino's. So Domino's Pizza up 0.55. They announced a month ago. And this was a request, so we're going to take a look at it. The market cap, 13.85. This stock had really gone up during COVID because everybody was ordering pizza. It really tanked. And man, if you bought it at the right time, you'd be sitting on a nice gain. This does pay a small dividend of 1.7. PEs are at 24 and then moving down to close to 22 in 2026. They're a slow grower, 5% growth last year. This year, they're growing a little better in the last quarter they closed. So they're consistent growers. So they're selling more pizzas, maybe raising their prices a little bit. And these guys are, their profits are not great. It's a restaurant. Free cash flow looks good. They've been growing it, which is good. And their gross margins are low because it's a restaurant. You know, you need to put ingredients into your pizzas and before you sell them. So this one here is kind of a nice stable stock, in my opinion, because everybody can, have a pizza once in a while. So the addressable market's quite big and people are comfortable, especially around football season, to buy pizza. This is going to be a consistent slow grower, single digit. The profit is going to expand a little better, and the PE is going to get sub 20. For me, this isn't a stock that I'd like to own, but somebody that maybe wants to own Domino's can own it. I'm not a big restaurant investor. I think there's businesses that I'd rather invest in that have greater upside, like healthcare stocks, these biotech stocks that we've looked at. I don't know that Domino's is going to double my money that I invest in them. I don't think it's going to double my capital. If I were to buy Domino's pizza, am I going to wake up 5 years later with my investment doubled? I don't think so. So Domino's is not a great investment for me. It might be a good investment for somebody who understands the business and is comfortable with Domino's. It doesn't pay a big dividend. It's just kind of out there. And I think the other force or factor that I think is going to hurt Domino's is we're in an era of food delivery, right? You can order from just about any restaurant you want to order. And I think that's taking market share away from the pizza delivery companies. For a long time, pizza was the food item, the menu that was delivered all the time. But now, geez, man, you feel like eating chicken, you can order chicken. You want a salad, you can order a salad and it'd be delivered. So you have a lot of delivery options now. It's not like, 20, 30 years ago when pizza was the option. You'd call up, order your pizza, it gets delivered. No, you can order anything now. So I think that's going to probably take away share from the pizza market. And that's going to hurt Domino's. I would expect, but that's just kind of high level, my observation. All right, let's keep rolling. Let's talk a little Applovin. We talked about DSP. Applovin is down 8.59. I didn't see any news that really concerned me, and the stock is doing well for the 1 year. This stock has been kind of a stock that has been a target to short sellers who want to say bad things about them because they use data, according to short sellers, inappropriately. And I get it. Facebook has been accused of that. Google's been accused of that. Apple's been accused of that. Everybody gets accused of, oh, you're holding data. We're going to accuse you of not using that data properly. But the stock is really just cranked up because Applovin's customer is our corporate customers that are using this ad tech, this technology, this software to optimize their advertising. So when they advertise, they will use this app to get the best return on investment in their advertising dollars. And their growth has just been excellent. They've actually been accelerating their growth. That shows me that these guys, their product, that's what the market wants. It's buying more of it. It's cranking up its revenue growth, and it's cranking up its cash flow. It's cranking up its profits. I mean, everything looks good on Applovin. So all the naysayers can keep at it because it creates nice entry points for those who are paying attention. And Applovin, I think, is a terrific opportunity. It's been consolidating over the last couple of months and give me an opportunity to accumulate some shares. So I'm glad to do it. I'm sitting on a nice gain, but you know what? I think it's going to go higher. If they keep getting it done, advertising online is just going to continue to grow. It's linear TV. The game's over. They're not going to get a lot of ad dollars. Where's advertising going to happen? It's going to happen on YouTube, Netflix, Amazon Prime, on Facebook, on Instagram, on TikTok, all those places. And that's where Applovin helps the advertiser, reach their target audience and make the most out of that advertising dollar that they're spending. So I'm good with Applovin where it's at. And when I look at Applovin, their valuation, I still see a 30% discount in the stock because of their growth rate. Their growth is stupendous. They've been growing that cash. So you become a cash generation machine like Meta, like Apple, like Google, like these really valuable businesses. You will become really valuable. And that's my theory on them, my thesis on them. So that cash is what keeps me in the game. I'm gladly buying more shares of Applovin because I think the market has it wrong. And I'm going to just accumulate shares on Applovin while the price is very, very attainable. And I'm going to go ahead and buy it. Looks like, Mike, you're going to drive a harder bargain than I am willing to drive, 550 to 560. And then you would sell around 6:15 to 6:30. All right. Good to know. All right. So that is Applovin. All right. Next one that I've never heard of this company. It's SBET. Sharplink Gaming engages in developing a treasury strategy centered on Ether. It operates two segments: affiliate marketing and Ethereum staking. Okay. So we're in the Ethereum market. And this has gotten a lot of attention. And I have owned Ethereum. I owned Ethereum coins. I've sold them, but I used to stake them and I'd make 4% or something like that. It's like a nice dividend. Now, the way that Ethereum is being treated seems a little out of place, a little mismatched. And here's my point is staking is like receiving a dividend. Dividend stocks tend to be lower in risk, lower in volatility. Or you can buy a bond and get a yield. You can buy bonds that yield 4%. Again, low risk. As soon as we say crypto, we're in the high risk era or area. So I think it's a mismatch of, hey, if you're trying to attract investors with a yield, you're not going to attract low risk investors. You should really, with Ethereum, I'd rather go after businesses or invest in businesses that are creating something with Ethereum, which I believe like Polymarket is built on Ethereum. It's either Polymarket or Kalshi is built on Ethereum. That's a real life business that's built on the Ethereum platform. I'd rather invest in one of those businesses if and when they become public, as opposed to just sitting on Ethereum trying to make a yield. That was my decision. I got out of Ethereum. I still own my Bitcoin. The Ethereum investment was productive. It was positive, but nowhere near the appreciation that I've seen on my Bitcoin. So these guys are $2.27 billion in market cap, revenues of $3.14 million. So that's a expensive stock. You're paying like 700 times revenue. Whew, expensive. Forward P 4.7. How is that possible? It's really discounted. Whoa, look at that chart. I can't explain it. Okay, this is like high risk, high risk, high risk. And so why is their revenue so low? They're just staking, and this is their staking revenue. So this is just a treasury of Ethereum, I guess. Okay. So they're going to announce on the 13th. I'm trying to get to their last earnings, and bear with me for a second. Swing and a miss. All right, so let's go back. So just show me your financials, guys. What am I going on a wild goose chase here? Oh, here we go. Okay. All right. Now we're getting to what I need. Where's the 10K? So 8K. So I want to look at their balance sheet and see if they're a treasury of Ethereum coins. And let me make this bigger. All right, so current assets. So this is their, so this is in, imagine thousands. And so they have, no, I think these are actual numbers. So $382 million of digital coins. Okay. This is what is going to be paid to them. I'm just not seeing where the value is in this business. And I think Stock Analysis had this wrong because, well, no, they have it right. These are actual numbers. Okay. Yeah, this there's just not enough value here. These are tiny numbers. What are investors thinking is going to happen here? You have Ethereum coins. I get if they appreciate in value, this is going to be worth more. But Ethereum hasn't done all that great. Bitcoin is a place to be. And that's where I'm going to stay. Because Ethereum, I started buying Bitcoin and Ethereum in 2017. I'm glad I did so. But ETH hasn't done as well as BTC. They actually did the same, huh? I guess because they had a really good year. So here was a separation. And here's where it caught up. All right. Well, this one here, I just don't know how they're going to make money. And if I'm going to be buying a company that has an Ethereum treasury, I really just buy Ethereum coins. It's easy. You can buy them on Coinbase. You can buy them on an ETF. I'll just buy Ethereum if I believe in the coin. And these guys are, if they're going to run a treasury, I'm just not interested. I'm interested in the businesses that are actually going to do something with Ethereum and create like an app or an ecosystem that's real. Like I just talked about Polymarket and Kalshi. Those are real businesses that are doing prediction markets. That's what I'm interested in. Sharplink, just I wouldn't be touching it. The valuation is just crazy. And you see this kind of volatility. It's like, whoa, what am I investing in here? This is super risky, especially over the last month. It's been losing money. I know that some very famous investors are kind of trying to capture the attention of crypto. Like Tom Lee. I like Tom Lee. I like Tom Lee a lot. But he has this Ethereum treasury and he's trying to do some kind of some using leverage to buy Ethereum and then do something with it. I think it's not going to be all that great. And I think Tom Lee is great at stocks. He's not a crypto guy. Crypto guys are, pure play crypto guys. They're different. They really understand the coins and they understand the projects that are attached to Ethereum. So this one here is just not, it's not making it into my portfolio. All right, let's talk about DLO. D-Local. So these guys are doing well for the 1 year, year to date, not as well, but that 1 year looks good. Okay. So what does D-Local do again? D-Local, together with its subs, operates as a payment processing platform worldwide. The company offers a robust pay-in solution that allows businesses to get paid for their products and services through various payment methods, including international. Okay, so this is a fintech company, and their stock has seen a nice rally in the August timeframe, 4.26 billion. And payment companies, they've got, some of them have just been dead, stocks. Like PayPal hasn't done all that great. Others like Block hasn't performed all that great. These guys pay a dividend. Wow, impressive. They're growing really well. Wow, impressive. That's good growth. Okay. And when we look at these fintechs don't make a lot of money because, they're charging a transaction fee, and that transaction fee is small. So their gross margin is 40%. They are profitable. These numbers look really good. DLO's numbers look pretty darn good. And I'm not sure I have a valuation on DLO, but 116 million. Is this a trailing 12 months? 116 million. They're growing really nice. So they are a little expensive at 4 billion, but let's keep going here. So they're going to keep growing. They're going to become a $1.59 billion business. Earnings per share at 1, and their profits are going to be good. The P ratio is going to come down. So let's take a peek at their balance sheet, make sure they don't have a bunch of debt. And they do not. They have over $500 million of cash laying around. They could pay off the debt immediately and still have over $500 million. So if they keep growing at these rates, this business, if they grow at 49% and they really get themselves on a better growth rate, let's take a look at their forecast. I might go 30 times their free cash flow, which is going to get me to like 363.6 billion plus that cash on the balance sheet. We get to like 4.1 billion. So they're priced fairly, in my opinion. It's not all that fantastic because they don't make a lot of money and their free cash flow isn't very good compared to others. And there it is, fairly priced. So D-Local, it's just not a really compelling situation for me. If I'm going to invest in a small business, small cap, it's got to give me a nice discount, 30, 50, 60%, because I can find other investments that are going to offer that if they're going to be a small cap. These guys don't have big margins, so they don't get to keep a lot of that revenue in the form of cash, free cash, and profit. So this one here is a pass for me. DLO is just too expensive. I would say that it's fairly priced. And if they continue to grow at like 50% and really come out with products that the market loves, it could change their valuation. But for now, it'd be a pass for me. All right. Looks like I caught up. Nope. I've got ADMA to go. So the market's closed. And where did we end up closing? So we ended up with the Dow up 1.18%. S&P was a little greener, and the NASDAQ was down 0.25. When we look at the heat map, looks like NVIDIA sold off a little more into the close. Apple held their gains. Google went up a little higher. Amazon went up a little higher, and a lot of green here in the healthcare space. Good to see that. I bought more UNH. Recently, I bought CBS. I brought Oscar. How did Oscar end up today? So it went up to 1.59. It was up higher during the day, but I thought it was overdone, the sell-off, so I bought into it. And if you're going to invest in Oscar Health, just be ready for some extreme volatility. It'll go up 20%. It'll drop 20%. It's going to be extreme volatility. Okay, so let's finish off the stream. ADMA Biologics. It's been in a sell-off. They announced on the 5th of November Their growth, this is the concern, is they were really exploding in growth, and now they've plateaued. 12% growth is good if you're priced as a 12% grower, but this stock really ran up in price, and now the market's like, whoa, hold on a second. You're not going to grow at 50, 100%. So I think that was a problem. So, hey, Paul, good to see you. And I cannot comment on Oracle, and message me and I'll tell you why. And SFM, is that Sprouts Farmers Market? We can look at that after ADMA. All right, so ADMA, let's get back to it. So we have a stock where the stock price really went up fast and then kind of plateaued, and the revenue hitting a point where it's not growing as fast as it was before. That's the problem. Now, if you can get into 26, 28, I think the stock's going to be all right. It's just got to stick to that. And the 12% growth in the quarter, that was, I think, troubling to investors that are like, wait a second, when are you going to start growing better than that? Because these are the first 3 quarters of the year. And if they came in the Q4, right, and let's say they were like 5% growth or no growth, oh, this stock's really going to plummet. So, yeah, this one is kind of a no man's land for me. It's just, this is telling me it's hit a plateau. Its revenue's decreased in momentum. So if they keep decreasing its revenue growth, investors are going to bail. They're going to be like, hey, I'm sitting on the stock at $12 a share. I'm out. I'm at $8 a share. I'm out. If you're not going to grow really fast and you're small, you're going to be susceptible to the stock really selling off. And that's my story on ADMA. Good luck with that. SFM, and then we're going to wrap up, guys. And again, I apologize for the screen problems. So it did well today. It's supposed to double. I think if they can get an earnings out there, and let's say they showed 25, 30% growth, I'm with you. But the last 2 earnings reports are concerning. This is what I'm concerned about, is growth went to 13.8 in Q2 and then 12% in Q3. So that's what I'm concerned about. So if they can get back to mid-20s, 30%, then I think that the stock will thrive. It went up a lot today. Was there news, or what was the story? Do you have an idea of why it went up so much? Interesting. All right, Sprouts Farmers Market. This stock was flourishing a couple of years ago because they're growing. They're a new kind of way of selling groceries. And this was one of the concerns I had with them, which is, the grocery business is tight margins, low margins. And these guys were growing because they were opening stores, which good for them. They were opening stores and where they thought it was a good place to operate a grocery store. And the same store sales were okay, but I think the growth of the business was kind of misinterpreted. Like, oh, wow, grocery business, it's growing at these rates. Yeah, because they're opening new stores. And it looks like Q3 growth was good, but I think same store sales that are being reported, the problems lie. And I don't think this is going to give it to me. No, this doesn't have same store sales. So let's ask Gemini. See, Gemini is going to be an investing tool. Yeah. So same store sales, 7.6%, 6.76%. So this is pretty good. And I think just take a look at the quarterly. That's better than like Kroger, which is a pure play grocer. And I'm going to open up their actual financials, because when you look at grocers like this and you're looking at growth, we have to look at same store sales. So this is where they're opening stores. Okay, great. But opening stores is kind of easy and it's capital intensive. So same store sales 5.9. So that's good. That's a good number. And the rebought shares. Okay. All right. Let's go back to it. So trailing 12 months, their growth is good. Same store sales was 5.9, but they added some new stores, which increases their overall revenue. Okay. Their profitability is, again, it's a grocer, so it's kind of low, but I think it's about the same as Kroger. And their profit is a little bit low. But if you compare it to Costco, Kroger, it's about right. Free cash flow is looking good. Okay. So 457. Okay. Forecast. Analysts think it's discounted by a wide margin. And they're expecting the company to continue to grow, earnings per share to really expand. So this looks good. All the numbers look really good. So the market's just been selling this one off quite harshly. Let's look at their balance sheet and look at debt. So they have $1.86 billion of debt with $322 million of cash. So net debt of about $1.5 billion. So these guys are, if I took their cash flow based on their growth rate, it's probably worth $9 billion minus debt. So it's worth $7.5 billion right there. They're fairly priced. I think I have a valuation on Sprouts Farmers Market and actually have it discounted. So their free cash flow, this is my estimate. They're coming in lower than that. 8% cash debt. That looks good. So this, I mean, it looks good. I'm in Kroger. I'm happy with Kroger. But I can't argue with somebody wanting to buy into Sprouts. They're growing their same store sales. That looks really good. They have the way they have their stores is, it reminds me of Trader Joe's. And you may have a Trader Joe's near you, which is a limited assortment, limited footprint. You don't have this giant store. You have a smaller store, and it tends to be stuff that people like. And it tends to be premium stuff, so they make a better margin. So those things I like. Now, would I want to buy Sprouts? I don't know. It does look interesting where the stock is setting up, right? It's been selling off like quite harshly. I mean, this stock was really rolling for a while. Kind of felt like I missed it, and then it just came back down. So interesting. It looks like an opportunity. I mean, if this thing can get back up to $100, $120 a share, you're in, and it's a good gain. So it's looking pretty good. It values well. Now, when would be the right time to buy this? The magic question is, I would say once it starts establishing kind of a upward trend. They announced earnings on the 29th, so that's behind us. What did it do on the 29th? So the investors did not like what they announced. Might be that they are putting a lot of capital into their business by opening new stores. And investors didn't like that, but geez, everything else looks good. So that one's a head scratcher. I hadn't looked at Sprouts in a little while. I thought it was going to be, fairly priced, but no, it's priced quite well. If you look at their direct competitors like Kroger has a big market cap, not growing as well as Sprouts, and I think the profitability is about the same. So yeah, so it looks pretty good. Thanks for asking on Sprouts, and appreciate you being a member. All right, so the Elder. Yeah, I thought healthcare had a good day. It really has had kind of a tough 3 years. Catalyst is a winner, right? This is a good winning stock. Look at this trajectory. They've been growing really well. They announced on the 5th. I like what they had to say. Good, profitable business. I'm a substantial stockholder in this company. So I'm glad that we're catching a nice, trend higher. So yeah, it's good to see healthcare, get a little attention, because when you look at these fundamentals, right, you have a market cap of 2.84 billion with revenue of 578. So you're paying less than 6 times revenue for the company, which is a very reasonable amount to pay for a business. The P ratio is low at 13.5. You would think they're not growing at all. Analysts think it's highly discounted because when you look at the growth of this company, it's growing really well. It makes a lot of money. It grows, generates cash, makes 83% margins, 33% net profit margins. Sign me up. I want businesses like that. They're growing, they make a lot of money, they generate a lot of cash, and they have no debt. Sign me up. So I'm a Catalyst investor. Whenever it's recently had some really low pricing, I bought more shares, and I'm glad I did so. I'm up nicely on those shares that I bought. So Catalyst is looking good. And it's still highly discounted because they just crank out cash. They're growing. Looks like a good stock. So keep going, Catalyst. Keep going. Keep appreciating your stock price, buying back shares. And most importantly, the reason that they had good news recently was one of their drugs is going to market, and it's got really good momentum behind it. So that's good news. So I really like Catalyst. Thanks for asking. And then you mentioned Genmab. Genmab came up a couple of days ago. Up nicely. I like what I'm seeing there. This thing had a nice rise. It kind of gave up some of those gains, and now it's rising again. Very good. Yeah. The rotation into healthcare, it's been, long coming. It's been a while. And part of it is that the money was going to the data center. And I get that. But you could find really nice biotech companies that have great growth. I mean, we've seen a couple on this stream that give you awesome valuations that make a lot of money. So those are opportunities. And I think we saw a couple today that look pretty darn interesting that I'm going to really keep an eye on, because I could probably add another small cap, but I'm being careful with small caps because small caps get tortured fast. Like, geez, as soon as the market drops, small caps just get sold off like crazy. So I'm trying not to get caught on the wrong side of those. So, all right. Thanks for the question there, the Elder, and thanks for becoming a new member. You just became a member yesterday. I appreciate that. Thank you. Mike, thank you, sir. Thanks for tuning in. And will Chipotle recover? Big picture, no. It's a restaurant. It's tough, man. Restaurants are tough, tough, tough. And what are they going to do? Like, okay, you sell burritos, you sell tacos, and it's not like you can all of a sudden say, well, we want to sell Chinese food now. So that way we could expand our, menu, sell more products. No, people know you for burritos and you stick to what you guys do. I'm not a Chipotle investor. I eat at Chipotle every once in a while. And sometimes I run into a Chipotle and the place is messy and it's a real big turnoff. I'm like, dudes, I want to eat healthy food. I want to eat quality food. And the way, their kind of assembly area, I've been to a couple of Chipotles where it was really messy. And I'm like, geez, you guys should operate a little cleaner. All right. So that is it, folks. Again, apologies for the new feature that the software that I use where it provided everybody a portrait view. Some people portrait view versus landscape. I'm just going to go back to landscape and give feedback to the software company. So sorry about that, but thank you so much for tuning in. It's been a good stream. I'm glad I did a stream in the middle of the day. It's nice to stream at different hours of the day. That way, maybe some people that don't get exposed to the live streams can participate. And I'm really glad that I saw a lot of members join, as well as some new names. Thank you so much for joining. And I hope you found the content interesting. I'll be streaming tomorrow morning with Daryl. So I'll do fundamentals. He'll do the charts. So we're going to be on 9 a.m. Eastern, 6 a.m. Pacific. Join us if you can. And then I'll stream again on Thursday in the afternoon, evening, and maybe you can join me then. So everybody have a terrific Tuesday. And last thing, most important thing is to all veterans out there, thank you so much for your service. It is very appreciated, the service you provided and the sacrifices you've made for our country. Thank you. That is it, folks. Have a good night. We'll see you.